All right, good evening, everybody. My name is James Monroe with Oregon Pacific Financial Advisors. I'm a financial advisor here in Medford, Oregon, and I appreciate you guys joining our webinar. We believe highly in financial education and believe highly in financial literacy. So we're going to go through a few steps on how to do this, how to be financially literate and get your financial house in order. So little background on me, I've been in the industry since 2006. And I've been doing financial literacy and financial advising since then. And recently, 4 years ago, moved up to the Rogue Valley and started a business here. And I was previously with another company and came over to Oregon Pacific about 2 years ago. So we're here to really just give an education and give value to everybody who's on the webinar tonight. So you should have received an email. In the email, there should have been a PDF that has a workbook in it. If you take a look at the workbook, we're going to walk through a lot of those steps in the workbook, and we're going to get started. I will stop between each section. We'll have 6 sections. I will stop between each section. I have my friend Marlene here that works with us, that if you want to put questions into the chat, she'll go ahead and facilitate those. A lot of the questions will probably be answered as we're going through it, but if you have a question, please put it in the chat, and if I don't cover it, Marlene will make sure to stop us and ask the question, and we'll be able to answer it for you. So again, welcome. Thank you for your time. My goal is to be done here before 6:30, so not to keep you guys more than an hour. I appreciate you guys taking time out of your day to be with us here tonight. So just a few disclosures that we have to put up there. United Planners is the broker-dealer that we run our business through as far as our securities business. Oregon Pacific Financial Advisors is the financial advisory firm that we run our business through. I am fully licensed, so I have my life and health insurance license. I am Series 6, Series 63, and Series 65 license. That doesn't mean a lot to many of you that are on here on the webinar, but basically what it means is that I'm fully licensed to do everything, for the most part, that's in our industry to give the best advice. So our workshop objectives today is to introduce you to some concepts and some things that you may or may not know, to educate you, and then to illustrate some examples of that. We're going to cover everything from sort of a 20,000-foot view. We can get into more detail in person and one-on-one with any of our advisors here at Oregon Pacific. Our commitment today is to help you provide some sound financial information. We want to help you maybe identify some goals, and then we offer a complimentary consultation after this. So if it's something that you're interested in and setting up and going through the process, it's complimentary, no charge, no obligation, no anything like that. Again, we're here to add value and to help you get through your financial goals. You also have an evaluation form that should have been emailed to you in the PDF that you received. If you have any feedback, we would love that back. If you want to email it back, that'd be amazing. And your workbook that you should have received, usually we have these in person. I have hard copies of them. As soon as the COVID stuff's done and we're safe to meet in person, we'll start doing some of these live and be able to pass those out and be able to meet face to face, which hopefully we're able to do that soon, as I know most of us are pretty zoomed out, including myself. So hopefully we'll be able to do these live and in person here really, really soon. So here's the 6 steps to financial success that we're going to talk about. The first step we're going to talk about is protecting what you have. The second one is taking control of your cash flow. Third one, we're going to talk about investing and investing wisely. Number 4, we're going to talk about some of the taxes and some of the things that you could save for, save money on taxes and invest so that you're not getting taxed every single year at a higher rate. Number 5, we'll talk about retirement. And then number 6, and probably one of the most important that gets overlooked a lot of the times, is leaving a legacy and really estate planning and things like that. So let's talk about step 1. Let's talk about protecting what you have. So key areas of insurance. So let me define the term insurance for everybody. The term insurance means the transfer of risk. With insurance, you're transferring the financial risk from yourself and your family to a company that is offering a contract to be able to pay for some of the things if something catastrophic were to happen, or any medical challenges or anything like that. So key areas of insurance coverage that we talk often about with a lot of our clients is medical insurance, long-term care insurance, disability income insurance, especially here in Oregon, because there is no state disability income, liability insurance, property and casualty insurance, and life insurance. So I'm going to tell you right now that it's very important to speak to people that are professionals in their industry, and that they're really keyed in on what they're doing. So if they're doing liability insurance or property and casualty insurance, we have many business partners that we refer to that we trust and we know and we work really closely with. I call them being on our team. So I'll mention our team a lot of the times. It may not be our team in the office, but a professional that we trust, that we work very closely with, that we've already sort of vetted for our clients as we go through this. So health insurance, the health insurance marketplace can be very confusing for the consumer. I have licenses to be able to sell health insurance. A lot of it's very confusing for me, and I don't specialize in health insurance. So I actually have a health insurance broker that I run my health insurance through personally. But being able to find and compare the private insurance plans and coverages and options and deductibles and costs and what's it worth and all that, be able to have some answers to some questions on coverage and options and eligibility, enroll in the best plan that meets your needs, and then claim it a subsidy if you qualify. You could visit the website healthcare.gov to learn about more of your options. I would recommend sitting down with a qualified professional that specializes in health insurance that, again, we could recommend to you or people that you know anytime that you have any questions. So with life insurance is where I started out in the industry. But real three critical questions that we talk about. Number one is, how much do I need, right? How much life insurance do you need? I use a method that we call the DIME method. So I look at debt, whether it's credit card debt, car loan debt, personal loan debt, student loan debt. Then I go into the income sector. How much income do we need to replace? And then if you have a mortgage or if you're covering rent expenses, how much of that do you need to replace? And then education for the children. If you have children, do you want to pay for some of their education? Do you want to pay for none of their education? Do you want to pay for all of their education? How do you want to do that? But really, it's a tool to cover the things that you need. And then what type of policy? What type of policy do you have? Most people hear about two types. They hear about term and whole life. So there's actually 7 basic different types of insurance that if I had a bunch of time, I could cover and do a whole hour-long talk on just life insurance. But term basically is you have it for a period of time, whether it's 10, 15, 20, 30 years. And then whole life is a type of a permanent policy, which is sort of like buying a house that you have forever. You pay on it forever, but you have it forever. So whole life is usually going to be more expensive, or permanent's going to usually be more expensive. In the short term, term's going to get more expensive in the long term, because as you get to the end of that term, it's going to end or it's going to go up. And then who gets the money? When I sit down with a couple, most of the time the spouses obviously get the money, but then after that, who gets it? What happens? I literally just got a message from a friend today that a 30-year-old couple that we know very well, my friend and I, they got in a car accident in Southern California and they passed away instantly, 30-something years old. I called the dad, who I've been friends with for 20 years, and offered my condolences. And, you know, it's catastrophic. It's horrible. But who in that case, who would get the money? Where would the money go? If they had kids, who's taking care of the kids? How's that dispersed? How's that sent out? And really having it done properly is very, very important. So life insurance is an important part of a plan, protecting what you have, protecting your assets, protecting to make sure that your children and your family are taken care of financially, so they can deal with the emotional side of stuff as they need to, as they're working through that, and not have to worry about any of the financial stuff. So group coverage may not be sufficient. A lot of times I sit down with people, they go, oh, I have life insurance through work. And I look at it and it might be 1 or 2 or 3 times their annual income. It might be what's called accidental death and dismemberment. That isn't really truly a life insurance policy. If you get sick, those don't cover you. I mean, certain things like that. So it's really having a review of that to make sure that, you know, like I said, things are covered that are important to you, that are important to the people that we're sitting down with. All right, so we'll go ahead and move on to step number 2, taking control of your cash flow. So one of the biggest things that, I hear is budgeting is hard. My background's actually personal training, and I used to hear dieting is hard. Dieting really isn't that hard, neither is budgeting. One of the things that you have to know is that budgeting is just you really telling your money what you're going to do before you do anything with your money. So taking control of that. So Let's talk about a company. So let's pretend that we're investing in a company. Let's all pretend we're on Shark Tank. So this company has accounting problems. They can't account for 20% of its cash flow. So 20% of the money coming in, they can't account for where it's going. Regular unexpected expenses, like things popping up. They announce unexpected charges against their capital every single 6 months or so. Delays in filing tax statements and returns. Would you invest in this company? Most people that we sit down with, especially when we're getting them started on a plan, I sat down with a couple this evening, and one of the things that they mentioned is that, hey, we need to be able to get on a budget that we can live with, that we can walk through and we can go through. So a lot of people can't account for a significant portion of their discretionary income, money they have left over after paying all their bills. They're forced to liquidate assets periodically because they have to pay for medical expenses or household expenses or stuff that they didn't put money away for in a specified emergency fund. They have to pull it out of their assets. And then they're routinely filing, they're filing delays on their filing statements and tax returns. They're filing extensions every single year. I try to tell my clients, look, I would rather know in February what I owe in April than figure out in June what I owe in July or August, right? So I would rather know ahead of time if I owe extra money to the government or more money to the IRS. So might as well get it done sooner than later and not procrastinate and kick the can down the road. So one of the things that we'll do, and one of the things that we can help you with, is assessing your current situation. So taking where you're at, helping you build a cash reserve, helping you pay down that credit card debt, car loan debt, student loan debt. We have programs available to be able to help people just learn the process and pay it down sooner than later through many different types of scenarios. Traditional savings vehicles, you've heard of savings accounts at the bank, obviously. Certificates of deposit, which now seem like what I call certificates of depreciation with interest rates being so low. And then money market funds are pretty safe traditional vehicles to be able to invest and save your money in. So let's take a look at the $160,000 credit card. So if you had a credit card balance of $30,000 and you were paying 18% interest on that credit card, and you were paying $541 a month for 10 years, you're going to pay $64,000 on that $34,000 just to pay it off. Versus having an investment, and by the way, I'm not saying that 8% is a sustainable rate that you're going to get every single year. I'd rather under promise and over deliver. But just for hypothetical reasons, let's say you were saving $541 a month in an investment, earning 8% over 10 years. That $541 a month over the course of 10 years would turn into $99,634. So I want to ask you a question, and this is sort of a rhetorical question. Would you rather have positive $99,000 or would you rather have paid out $64,000 and not had the cash flow? I mean, I know the answer, but it's a $164,000 difference in net worth. We can help you through the process, learn how to do that and start in the positive side of saving money and paying off that debt and do it all at the same time through a planning process that we do. So step number 3. So one of the things that we talk about is first having an emergency fund, protecting what you have, having the insurance. And then the next step is really investing. Let's talk about investing wisely. Where do you invest? What do you do? So Mr. and Mrs. Taylor, they're age 50. They have $1 million portfolio in one type of investment. They didn't protect against any risk. They didn't do what's called diversify. They didn't do what my mom told me of not putting all your eggs in one basket. They put it in one investment, one type of investment, and that's it. So let's pretend that this is, let's pretend that this is the beginning of 2020. 2020 has been sort of a crazy year. So during a bear market, their portfolio lost 50% of its value. So let's say they were retiring at the end of 2019. They only have one investment, and all of a sudden they lose 50%. Their $1 million has gone down to $500,000. So I want you to think about it. If you lost 50% of your money, how much in a percentage do you have to earn back to get back to even? Most people I talk to say, oh, well, I have to earn back 50%. I thought the same thing when I started in the industry before I started learning some of the concepts. But if you earn back 50% of $500,000, you only earn back $250,000. So your total is only at $750,000. You actually have to earn back 100% to get back to even. And if we looked at March, if we looked at 2008, 2009, there were some crazy market changes and things like that that happened. And that's why we always recommend sitting down with somebody who's qualified, who's licensed, who understands the market and the market trends and can give you proper advice, not based off of timing the market, but based off of really timing when you need the money and when you need to get that. So lessons learned by the Taylors. They learn how to diversify their investments, not have all their eggs in one basket. Assess their risk tolerance. Now, I believe that, your risk tolerance needs to be assessed every, few years. As you get closer to needing the money, as you get closer to retirement, we reduce the risk that we're taking and we move it into stuff that's more conservative versus trying to go, okay, well, it's at the bottom, let's invest, because we don't know, we don't have a crystal ball. And then managing the portfolio and meeting with everybody every single year and making sure that we have communication. I don't know how many times I've met with clients that have a past advisor that they haven't met with in 10, 15, 20 years. And they just know their money's kind of there doing whatever it's doing. A couple different types of investments, pooled investments, so mutual funds and ETFs. These investments may combine stocks and bonds or a combination of them. Other securities into one portfolio may be shared by investors. So understanding the different options that you have and working with people that, again, have the licenses and then have the ability to be able to shop the market and find the right investments for everybody is very, very, very important. So why do people invest in mutual funds and ETFs? Well, number one, convenience. It's pretty simple, to understand that we're not always going to pick the best stock, and most advisors, most people aren't sitting behind a computer watching the stock market all day long. A lot of times they're helping their clients. So they're sitting down with people and they're making sure that they're managing, their clients' portfolios and their plans and things like that. If you look on page 8 of your workbook that you had received, it'll talk about some of the objectives and talk about some of the risk tolerances and things like that you can go through and do a self-assessment. And if you do decide to meet with one of us, we'd like you to bring that with you so that we can go through that process with you. I talked about professional management, flexibility on being able to invest a certain amount, and then diversification, be able to spread out the risk between different companies, different risk tolerances, different types of funds and ETFs and mutual funds and things like that. But really helping you to understand in English instead of speaking financial plannerese to people is what we really specialize in. Types of funds we can look at: money market funds, municipal bond funds, income funds, balance funds, growth and income funds, growth funds, international global funds, sector funds, aggressive growth funds. When I first learned this stuff, it was Japanese to me. And to be honest with you, I wanted somebody to explain it to me in English. And they did, which is how I got started and why I got started in this industry. People should understand at a level that they can understand it, and again, be spoken to in ways that they understand, so they understand where to invest and what to do. I had a friend of mine call me today and say, hey, I'm eligible for my 401k. Can you help me understand what each one of these things mean? Because I don't understand it, and I don't know what to do. They told me to look at this and then click a box and do that. And he goes, I don't like that idea. So I walked through the different definitions of all the funds that they have available. And I said, hey, look, depending on your risk tolerance and kind of how you feel about it, here's kind of the lineup, or here's kind of the area that I would put you in. At the end of the day, it's your choice, but here's what all that means. And he goes, thank you so much for explaining it to me. Nobody else has done that for me. Let's talk about managing your taxes. So step number 4, taxes are awfully confusing. There's a lot of lines and a lot of numbers and a lot of things that goes into a tax return. And I will say that we are not tax professionals. We do not do taxes. We understand them at a level to be able to help people make smart, intelligent decisions with their money. But again, I can refer people to teammates of ours, people that we work very closely with, that can help you with your taxes and help you in the right way that's in the best interest of you and what you're looking for, and also be cost effective, kind of depending on where you're at. So let's talk a little bit about taxes. So all taxes are not equal. Statistically, 60% of the federal income tax are paid by the wealthiest 5% of taxpayers. 60% of those income taxes are paid by the wealthiest 5%. Those wealthiest 5% are households with an adjusted gross income of over $248,304. So people making $250,000 and more are paying 60% of the federal income taxes in America right now. So just know not all taxes are equal. So let's take a closer look at the tax return. One of the things that people need to be conscious about that most don't realize is that you have this thing called taxable interest. What's taxable interest? Taxable interest is from accounts like a CD or money market fund or some mutual funds and things like that, where the interest you get credited to your account, you actually pay a tax on it. What it ends up being is it ends up being what's called an unrealized income tax that you end up paying taxes on. So if you look at this, these were the savings accounts, the checking account, the certificate of deposit, things like that that they paid an income tax on as income that they never got, that they never used. It's just sitting in the account and kind of reoccurring. So why pay taxes on income that you aren't using? Why pay that income tax on that? And again, having somebody to be able to sit down and explain that to you and walk through the process of how do I not pay that extra income tax, especially on the income and on the interest that I'm not earning or I'm not using. So if we looked at some of the filers, if we looked at capital gains tax is another tax that folks will pay. Long-term capital gains up to $40,000 is single, up to $80,000 is married filing jointly. They'll pay a 0% on the income tax or on the capital gains tax. Single filers from $40,000 up to $441,000 in income, and then married joint filers $80,000 up to $896 will pay 15%, and if you're over that income, you'll pay a 20% capital gains tax on some of that. So just know that there's different types of taxes, not just income tax, there's capital gains tax that you could pay on some investments and things like that. And again, we work very closely with CPAs and tax preparers to make sure that you're getting the best bang for your buck when it comes to your long and short-term capital gains taxes. Some tax favored investments would be things like municipal bonds. Municipal bonds are used for roads and bridges and schools and things like that by municipalities, so a city or a state or something like that. Roth IRAs are a good investment. However, Roth IRAs have some limitations when it comes to income and the amount of money that you can put into it. But basically, you put in after-tax money into a Roth IRA, and when you take the money out after you're 59 and a half, you don't pay any taxes on that money because it was post-tax money that went in. Then we have these tax-deferred accounts. Tax-deferred accounts is just like it sounds. We're deferring the taxes. So we're going to not pay taxes today. And then when we take it out when we retire after 59 and a half, now we're going to pay taxes on that money. Well, I don't know. I don't have a crystal ball. I don't know if income taxes are going to be higher or lower 30 years from now. My guess is that they're probably going to be higher, right? So it's a fine line of working through that process on how much do I put in the tax deferred column and how much do I put in the tax exempt column to, again, for me to get the best bang for my buck. But things in the tax deferred box is the traditional IRAs, again, has some limitations on how much you can put in. Employer-sponsored retirement plans. So we talk about 403Bs, 401Ks, 457s, TSA accounts, all these. If your job offers it, simple IRAs, SEP IRAs, that's an employee-sponsored account. And then lastly is annuities. So there's two types of annuities. There's qualified annuities and there's non-qualified annuities. A qualified annuity would actually be an IRA with an annuity wrapped around it for protection as insurance. A non-qualified annuity would be after-tax money that goes into that. So say from a CD or money market fund or savings account, and then it grows tax deferred. And then when you take the money out, you don't get taxed on all of it. You get taxed on whatever it gains. So for example, if you put in $100,000 into a non-qualified annuity, that $100,000 grew to $120,000 before you took it out. The $100,000 that you put in, you're not going to get taxed on again. But the $20,000 that it grew, you're going to pay an income tax on that $20,000 as it comes out. So just something to sort of be aware of and understand. And again, this is stuff that we can go over, in when we have more time. So let's talk about some contributions and some contribution limits. So why does it say $6,000 and $7,000? Well, if you're under 50 years old, your contribution, your max contribution into a traditional IRA or a Roth IRA is $6,000, but you don't get the tax break today on a Roth IRA. You get a $1,000 catch up if you're over 50 years old, so your maximum contribution would be $7,000. So let's say you're under 50, you're contributing $6,000 to your IRA, and let's say you're in an overall tax bracket of 32%. By depositing that $6,000 into your IRA, you would save yourself $1,920 in taxes to the IRS. So you're just deferring those taxes for later. For when you go to retire, and that's after 59 and a half, so you don't have to pay penalties on that money also. So the taxable equivalent yield. So taxable equivalent yield basically means if I put something into a Roth IRA, or if I put something into an IRA, how much interest do I have to earn if it's going to be taxable later, if it's going to be taxable in the future. So let's say I have a municipal bond. Let's say a municipal bond is paying me 4%. Well, if I'm in a 32% tax bracket, I would have to earn 5.88% in an investment inside of that IRA to have the equivalent of the income coming off of that. So again, if I have $100,000, I put it into a municipal bond, it's going to give me 4%. It's going to give me $4,000 a year. That's not taxable. To have the equivalent, if it was a taxable account, I would have to earn 5.88%. So I would have to earn $5,880 on that. Then it's going to be taxed as it comes to me. Then I would get the same $4,000 net. So just understanding that there's some process and some processing that we work through as we go through some of the planning stuff. So step number 5 of our 6 steps is saving for retirement. Retirement is one of the biggest things. I always tell people, you know, most people don't or they don't plan to fail, but they fail to plan, right? I sit down with a lot of folks that are in their 50s and they're going, well, I haven't saved much for retirement. We need to start. And we need to understand Social Security. We need to understand what we're going to get from our retirement plan and how can we do it without running out of money and things like that. So this is a part of the retirement planning that we go through. So let's say we have the Smiths. Well, they have enough to retire. Well, they're 64 years old. They want to retire in about 2 years. They currently live on about $12,000 a month gross. They want $9,000 per month in retirement. So they have Social Security. They have a couple 401k plans. They have a little bit of some personal investments and some personal savings. Their Social Security is going to give them $2,750 per month at full retirement age. Now, if they're 64, full retirement age right now is probably 66 in 8 months, is my guess. If they were 60, it would be 67. If you're under 60, you're probably close to 67 and a half. If you're in your 40s, we're looking at 68. So I always tell people Social Security is probably going to be around. Again, I don't have a crystal ball, but what's going to happen is they're going to delay the time that you're going to get that what's called full retirement. They're going to delay that time because now we have more retirees to people putting into Social Security into, you know, through their taxes and through their checks. So they're just going to kick the can down the road and make it so you're older and older and older before you're able to take that. Their 401k plans, without them running out of money, hypothetically, they could take about $2,000 a month out of their 401k plans. Their portfolio, so their investment portfolio, has about $450,000 inside of it. That could probably generate about $2,250 a month if we assumed a 6% interest rate, which is, you know, fairly okay. We could get there. So if we add it all up, they still fall short about $2,000 for this hypothetical. So what are ways that we could, you know, that we could change that we could adjust some stuff? Well, we could use things like annuities. We could use things to be able to make sure that they don't, you know, again, run out of money. We want to make sure that they're able to retire successfully and stay retired once they get to that point. We could also calculate and consider, you know, certain factors like retirement age. I've told clients, hey, you should wait another year and a half before you retire. Their length of retirement, obviously that depends on life expectancy. That depends on, you know, longevity in their households and things like that. Other sources of income. Do they have a business? Do they have something that they could do? Is there other things that we could adjust? And what about their lifestyle? How much are they eating out? What's their budget look like? How much do they want to travel? Where do they plan on traveling? How do they plan on traveling? And really help them to consider a whole bunch of different factors to make it, again, so they can retire when they want to with dignity and make it successful, so they don't have to go back to work because they've done a good job at saving money up to that point. Step number 6, let's talk about leaving a legacy. One of the things that I urge clients to do, one of the things that we've done for our family is put an estate plan together. And most people go, I don't need an estate plan. I don't have a big estate to leave. Well, let's consider some factors. Do you own a house? Do you have any type of savings? Do you have savings at the bank? What happens if something happens to you? Who pays your bills? Who takes care of, you know, the power of attorney? Who takes care of the financial power of attorney? Who makes medical decisions for you? How do you want your healthcare directive to be? Who do you want to make those decisions for? Do you want your family to go through probate? Things like that. So what could stand in your way? Probate. Probate is a very, very, very public hearing that goes through when a couple passes away and there's an estate that's left without any planning done previously. That, you know, I've seen and watched in my 14 years of the industry. I've watched families get torn apart through this probate process because mom said I should have this ring and dad said I could have this watch and all that stuff. And it's just a process. And again, we have very qualified people that we refer to make sure that we take care of the estate planning properly. The next one is taxes. What happens? What happens when we pass away? How do we file our last taxes? What do we do? Again, we have qualified people we work with in the long-term care. A lot of people are going to need, a long-term care type of a service. What happens when you get to the age? Is there dementia in your family? Is there Alzheimer's? Is there, certain cancers and certain things? Are you going to need somebody, a nurse, to come in? What do we do? What do we do about that, right? What about, the court proceedings and probate? It's legal, financial. It's not private, just like I mentioned. It's expensive. It could be, $10,000 sort of on a minimum up to, I've seen, $40,000, $50,000. It's time consuming. It takes somewhere between 6 months and 3-4 years. It could go through this process because it's a public process. They have to make sure that all the debtors are paid off. They have to make sure that everybody that's sort of fighting through this process, if mom and dad had assets or diamonds or jewelry or earrings or whatever, that they get through the process so that the estate's closed, so that everything's done. So we recommend setting it up and having it, pre-done with an attorney. Federal estate taxes. What's the net value of the estate? What's the estate tax exclusion? Well, the federal estate tax exclusion currently for a couple is $11.4 million. In the state of Oregon, the state tax exclusion is $1 million. So how simple is it to get to a $1 million estate? Well, let's say you have a life insurance policy for $750,000 and you own a home that's $300,000, and then you have a 401k that has $500,000 of it. Well, your life insurance falls into your estate taxability. So that goes into your estate. So there may be some estate taxes due to the state of Oregon. And we will do a webinar next year with an estate planning attorney that'll talk about this in more detail. But then what's the taxable value of your estate? And who pays that? Who walks you through that process? Who does that? That's one of the services we're able to help people walk through that process as we go through it here at Oregon Pacific. Long-term care. 70% of 65-year-olds will need some sort of long-term care service at some point in their lives. Long-term care is expensive. It's not cheap. And it's not fun. And I don't know about everybody here on the webinar. I don't want to be a burden to my kids when they're adults to make it so that they have to take care of me. I don't want to be a burden on my family, on my siblings. I don't want to be a burden on my spouse if something happens to me. I need a long-term care coverage. I want to make sure that we have our stuff in place so that we don't have to worry about that. And we walk through the process. We make it so that stuff's set up ahead of time when you're younger and you're healthier, and it's more inexpensive. Long-term care costs across the country. So if we looked at New York, which is fairly expensive, it's $146,000 a year on average. California is $117, Florida is $108, Ohio is $94, Texas $78. The national average of nursing home cost is $100,000 a year. And that was by a survey in 2018. So costs may have gone up with inflation. They just haven't done a survey for it that we found. So if you consider that, who pays for that? How do you pay for that? What part of it would Medicaid pay for? How do you have to draw down your assets? Do your assets pay for it? Or do you have insurance in place and a plan in place to be able to take care of some of those long-term care needs that you're going to need? And then estate distribution techniques. So wills, jointly held property, contracts, trusts. What's the proper way to have your estate distributed? What's a proper way to have the funds distributed, or your home, or things like that? One of the things I mentioned a little bit earlier, if you're younger, I have a 1-year-old and an almost 4-year-old. Who takes care of my kids? Who do I decide, or does the state decide? Well, if I don't have it in writing and have a plan done, the state decides for the best interest of my children. Who takes care of my children? What if that wasn't my wishes? What if that wasn't who me and my wife wanted to take care of it? So we want to make sure that that stuff's taken care of properly. Plus, our life insurance, I always say I don't want somebody winning the lottery from my death. So if something happened to my wife and I, how does that money get distributed out to make sure our kids are taken care of properly? Again, we have that set up through our trust, through our estate plan, to where the beneficiary is that, and then it disperses it out per the instructions that my wife and I put together with our estate attorney. And additional estate documents, power of attorneys, durable power of attorneys, medical durable power of attorneys, living wills. Again, sitting down with a qualified professional that specializes in this stuff is always a recommendation. Testamentary and living trusts, right? What's the difference? Well, a testamentary trust helps control some distribution, can help reduce some fees and taxes, but does not avoid probate. So a testamentary trust won't avoid probate. It'll still go through that public process of probate. A living trust will help control distributions, can help manage fees and expenses, but can avoid probate as long as properly structured. So I've had a lot of clients, and I mean, I have some services that I know of that are sort of DIY estate planning services. I don't usually recommend those to people. I recommend sitting down again with a qualified person to make sure the proper boxes are checked, it's funded properly, stuff's put away properly, and that you have somebody else looking at it. Because to be honest with you, again, I don't want to be a burden on anybody when I'm not here, financially, administratively, anything like that. I want to have, my wife and I want to have everything in place so that nobody has to guess what our wishes are, so that it's all done. And again, we have professionals that we refer to that are on our team. So that concludes our 6 steps to our financial success in our webinar. If we have any questions, you can put them in the chat. Marlene, do we have any questions pop up in the chat?
So far, we haven't had any questions, but we have had a couple of great, helpful comments from Kathy Kelly. Thank you so much for those.
Thank you, Kathy. And when there's no questions, it either means I did a fantastic job at explaining stuff, or that you're afraid to ask them. So hopefully we get a chance to meet with you one-on-one. So where do we go from here? Well, you could do it yourself, right? I mean, all this information is easily available for everything online. I mean, you could find just about anything that you want. You could work with others. I mean, there's obviously other financial services companies and firms and advisors and things like that. I know a lot of them, and I know a lot of them are awesome. You can work with others. You can work with us, which is obviously what we would like to see and like to recommend, just because we know that we're coming from an educational standpoint. We're going to work in the best interest of everybody that we sit down with. Or you can procrastinate. Procrastination, I've always said, is the biggest nation, kicking the can down the road. Like I mentioned earlier in the taxes, I want to know in February what I owe if I owe anything in April, because you could delay the payment, but let's go ahead and get it filed and get it done and rip the Band-Aid off versus pulling it off slowly, right? So we obviously don't recommend procrastination. We obviously recommend taking action. And if you're here on the webinar with us, that means that you're interested in the information, you'd like to take action. We have an evaluation form that you can email back to the email that came to you. You can email it to myself. My email address is james@opfa.com. Again, it's james@opfa.com. And if you're interested in scheduling a complimentary consultation, we'll go ahead and get that scheduled for you. If you're not, it's okay. You can let us know. And then we'll let you know what to bring. And again, we thank you for your time. And thank you for joining us this evening. As I promised, I kept it under an hour. And if you have any questions, please feel free to reach out to us. We're available here from 8 a.m. to 5 p.m. And you could also email me, again, at james@opfa.com.